Warren Buffett has been selling huge positions in his equity portfolio. Whether Bank of America or Apple, Buffett's Berkshire has been dumping shares and raising massive amounts of cash. So understandably, the whole investment world wants to know why that might be. One glaring divergence among two key stock market indexes seems to have that answer. Now, I don't have much use for stocks because they're not fundamental, or mostly not fundamental. Stocks go up because people buy them, and then later on, someone supplies a narrative as to why that was. The simple truth is that Americans in particular put most of their savings in equities, so they go up so long as Americans put their savings in them. They don't tell us anything about economic circumstances, especially the last decade. We get even less from the stock market where it comes to liquidity. This isn't hard to document. Just look at the ridiculously strong correlations between indexes and places that otherwise have nothing else in common. Why is Germany's DAX a near perfect match for the S&P 500 when Germany has been mired in recession for 2 years already? And we'll come back to that one. There are times, though, when you might want to pay closer attention to stocks. Warren Buffett selling as much as he has is one of those. Another is when two key indexes that were highly related and traded together like they were twins, all of a sudden they diverge. And when one of those two just so happens to have a track record for being a cyclical indicator, all the more reason to consider the possibility of the signal. And when that divergence traces back to a time period that shows up in a whole lot of other markets well outside the NYSE or Philadelphia, it starts to tell a compelling story, or at least add another chapter to one that is already being written. Are these stock market signals trying to tell us something very important about where the US and global economy are heading, or where they may already be? Given the amount of shares that Warren Buffett is selling, we better hope not. And Warren Buffett and Berkshire Hathaway selling has gotten a lot of attention because it is absolutely enormous. According to CNBC earlier this month, Berkshire Hathaway's monstrous cash pile topped $300 billion in the third quarter as Warren Buffett continued his stock selling spree and held back from repurchasing shares. That's a big one too. The Omaha, Nebraska-based conglomerate saw its cash fortress swell to a record $325.2 billion by the end of September, up from $276.9 billion in the second quarter, at least according to its earnings report released a couple weeks ago. The mountain of cash kept growing as the Oracle of Omaha sold significant portions of his biggest equity holdings, namely Apple and Bank of America. And that's one I've mentioned before for what should be pretty obvious reasons, given what we're seeing, as I reported in yesterday's video, about delinquencies among the more cyclical types of consumer and household debt, credit cards, auto loans. They're telling us something about the economy too. They're telling us something that happens and pertains to Bank of America. Now, Warren Buffett, ever since the summertime, has been selling loads of shares in Bank of America in particular. He's also been selling quite a lot of Apple. Berkshire dumped about a quarter of its gigantic Apple stake in the third quarter, making the fourth consecutive quarter that has downsized this bet. Meanwhile, since mid-July, Berkshire has reaped more than $10 billion from offloading its longtime Bank of America investment. And I don't think that is just coincidence. We have a lot of things going back to the middle of July. I already talked about the US CPI report that kicked off the reversal in the carry trade, or at least kicked off the more violent stage of that reversal, because the US CPI, the marching band full of red flags, held a lot of warning signs about where the US economic condition was and where it was likely to head, not toward a soft landing. So it's understandable that these various markets, including the stock market too, at least parts of it, we're picking up on the same signals. Whether it's the US CPI data itself or not, the underlying conditions have shown up in so many places, including the dollar exchange value, as I've been talking about in other recent videos. But another important aspect here, back to the CNBC article, Berkshire didn't repurchase any company shares during the period amid the selling spree. Repurchase activity had already slowed down earlier in the year as Berkshire shares outperformed the broader market to hit record highs. And I believe this is the first time in quite some time that Buffett hasn't bought back his own shares, suggesting again that what's going on here is that Berkshire, Buffett, the entire organization views equity prices in general as being overvalued. Now, there are other explanations as we go back to the CNBC article one more time. It potentially has to do with capital gains taxes. Buffett has hinted this year that he was selling some stock holdings on the notion that tax rates on capital gains would have to be raised at some point to plug the growing deficit. And Buffett's probably not wrong in that regard, because at some point, some administration somewhere at some time is going to have to deal with the mismatch between revenues and expenses from the federal government. Not about the treasury market blowing up, just plain common sense. The issue with the debt is how much of a drag government spending is, inefficient, as wasteful as it is, on the overall economy. And it would be prudent to try to at least generate revenue from some place, including raising capital gains. That's certainly on the menu. Maybe not for a Trump administration, but at some point that's going to come back. But I don't think that's what Buffett is actually doing. That wouldn't be enough for him to completely unload as much stock as he has, to raise more than $325 billion in cash and then just hold it. That's the other part of this. Not only is he not buying back his shares with that cash, he's also just sitting there on it, as if he was saying, in fact, he did say, at the May shareholder meeting for Berkshire Hathaway, Buffett was quoted as saying, "I don't think anybody sitting at this table has any idea of how to use it effectively," talking about the cash pile, "and therefore we don't use it. We only swing at pitches we like." So he's basically telling you stocks are, in his estimation, overvalued in general. We've seen that with Apple shares in particular, as well as Bank of America is a big one because of how much that's tied to the credit cycle and credit conditions in the real economy, but also Apple. According to the 13F filings, Berkshire Hathaway held 905 million shares as of the fourth quarter last year. That was pared back to 789 million in the first quarter, and then 400 million in the second quarter, and 300 million as of the latest filing. So Apple, as Berkshire's biggest holding, has been pared back an enormous amount here in 2024. In 2024, we continue to get all of these signals that the downside of the supply shock is indeed a downside of the supply shock, and it is getting worse, not better. And where would we see that downside of the supply shock getting worse but in technology, in semiconductors? Stuff related to Apple and Apple's products, highly cyclical semiconductors. And that's the divergence I was talking about in the introduction of this video. We look at the Philadelphia Stock Exchange Semiconductor Index and the S&P 500. Those two were practically twins for years. Goes back further than the last couple of years. But you go 2021, 2022, 2023, and the first 7.5 months of 2024. The SOX, as it's known, and the S&P 500 were very tightly correlated, which, as I also mentioned in the introduction, is something that shouldn't happen. And the only reason it does happen is because most of the time stocks aren't really trading on fundamentals. They're trading on other factors, including just Americans saving more money in equities. The semiconductor index and the S&P 500 should not be this highly correlated. And they were highly correlated up until that point when the CPI report came out in the middle of July. So July 11th, the semiconductor index sells off because we see a lot of signals around the world, this maybe having a little bit of a Japan carry trade flavor on top of it. U.S. economic risks were rising, were perceived to be rising, and they were perceived in this highly cyclical index. July 16th, the S&P finally joins in, and the two sell off pretty substantially late into July and early August, the yen carry trade explosion. But then, ever since early August, the S&P 500 has come roaring back. It was, first of all, a smaller decline during the sell, but it has come absolutely roaring back, new record highs and all of that. Whereas the Philadelphia Semiconductor Index has traded more like the Nikkei in Asia, essentially going sideways to lower since around middle of July. So it's up off the lows in August, but it really hasn't gone much of anywhere, meaning this divergence now lasts a total of 4+ months. This is a critical divergence because the semiconductor index and the semiconductor business overall is a well-known cyclical indication. Here's Franklin-Templeton. The semiconductor industry has long been a poster child of cyclicality. Historically, industry revenues have been 90+% correlated to global gross domestic product growth. Why would value investors want to own these stocks late in the cycle? And what the SOX index is saying is that maybe this is late in the cycle. Because think about it, the semiconductor business has been an atrocious business over the last several years. Suddenly, where there's some nascent signs that the business may be picking up, maybe they're just false signals, now all of a sudden in July, the semiconductor index diverges from the S&P 500. Why was it in July? Why wasn't it back in 2022 when the cyclical downswing in specifically semiconductors was at its most obvious? What changed in July? Summertime stumble, summertime time for recession. Here's another one, Deloitte. The infamously cyclical semiconductor industry had a challenging year in 2023, the seventh downturn since 1990, with sales expected to be down 9.4% for the year. But that's not as bad as was expected in the spring, before a relatively strong second and third quarter, and the previous forecast had been $515 billion. Now, 2024 was predicted to see global sales of around $588 billion. So things were looking up in the semiconductor business, at least from that perspective. And then something happened in July. The semiconductor index was happy to trade along with the S&P 500. No fundamentals, don't care about anything. Then suddenly in July, now the semiconductor index is with the Nikkei and other indications of cyclicality, swap spreads, for example. It tells you that something has shifted. Even the stock market, or parts of the stock market, has been able to pick up on. I mentioned the Nikkei. The Nikkei index, well, that one hit a record high in early March, and then it backed off. I mean, there was rate hike angst from the Bank of Japan, and as we know, stock market investors are convinced that higher rates are somehow bad for stocks, and it becomes a self-fulfilling prophecy. But it was only enough to back off the Nikkei index for a couple of weeks there. It rebounded, and then June into July, early part of July, another record high in the Nikkei 225 on July 11th. The US CPI, suddenly carry traders and everything else that goes along with them. And the consequences of the carry trade reversal seen from the perspective of the Nikkei index. So we have the Nikkei down big throughout July, just like the semiconductor index that crashes in early August. Obviously, the big one that got most people's attention. Then it crashed again in early September when we saw repo fails jump, the 3-month bill spread, or the 3-month bill rate in Japanese government bond markets, that one dropped. Swap spreads, everything in early September suggesting another sharp unwinding of the carry trade. And we see that also hit the Philadelphia Semiconductor Index as well. But it got back to 40,000, the Nikkei, on September 27th, but it's been sideways to lower ever since then, just like the Philadelphia Semiconductor Index. So it's a similar pattern to the SOX, which means that the SOX went from trading and corresponding to the S&P 500 to suddenly trading on yen carry trade after effects and byproducts, when the yen carry trade itself is being unwound due to concerns about the cycle in the US and what the downturn in that cycle might do to the rest of the global economy. There's also another divergence that's shown up too that we probably should note here, and that's between Germany and France. So you have the German DAX index and the French CAC index, big cap stock indexes for both countries. And they had been, just like the SOX and the S&P 500, and in fact with the S&P 500, both Germany's index and France's index, they had all traded together in basically lockstep fashion up until around this one, the middle of May. Suddenly, the French stock index has a much worse time performing than its German counterpart. Now, a lot of that could be chalked up to the elections that happened around that part of the calendar, though not necessarily explaining this divergence that we see developing, because French elections, the parliamentary election that really kicked everything off, went the same in France as it did in Germany. Now, the French responded to it with a snap presidential election that didn't go quite the way that maybe the French President Macron wanted it. But either way, the undercurrent of electoral dissatisfaction was there in Germany as well as France, yet it only traded in French stocks, not German. And the German DAX index has corresponded and continued to correlate with the S&P 500. So that suggests a couple different things. Maybe there is really the election difference that explains the divergence. Or what it really suggests is that the French index is more economically and macro sensitive suddenly, just like the SOX index is in Philadelphia, whereas the German DAX index and the S&P 500 they're more for show. They're more for just where people park their money because in broad indexes because it's perceived to be the safest and best opportunity out there. So the CAC index, like the SOX index, picking up more macro-focused fundamental signals, and therefore greatly and noticeably diverging from what had been dependable correlations for years. And at the same time as all this is happening, Warren Buffett is escalating his shares and refusing to buy other alternative investments or to reinvest the cash proceeds into other investments. From Warren Buffett's perspective, or what we know of Warren Buffett, it seems the most obvious explanation is tax gains, or capital gains taxes, and that type of thing. But the most obvious explanation is share prices are overvalued. Overvalued because of what reason, though? Is it just because share prices have gotten too far ahead and the economy is generally fine and everybody's just a little bit too excited over this year, soft landing, lower interest rates, and all that? Or are we seeing overvalued because economic fundamentals are shifting in the wrong direction? That would certainly go to what we know of Bank of America, what Bank of America has reported, what the Federal Reserve reported as far as rising delinquencies, which all tie back to the same cyclical processes. So Buffett's overvalued stocks, maybe not just about stocks going too far ahead, maybe also he's worried the business cycle is shifted too. That's certainly the verdict, what appears to be the verdict from the Philadelphia Semiconductor Index. Rather than having fewer signals, fewer negative signals, we keep getting more, including those now from the stock market. Summertime was indeed maybe the time for a recession. That's what we keep coming back to over and over again and in more and more places. The downside of the supply shock isn't just continuing, it may have actually accelerated the downside to such an extent we're seeing it in stocks as well. Maybe that's what Warren Buffett knows. Maybe that's what he's doing. Maybe that's why we see these key divergences. And it's just why those divergences are correlating strongly with everything else. But what about consumer spending in the goods economy? What are they saying about the cyclical prospects in the US? Well, I talked about that with Steve in the video link below. As always, thank you very much for joining me. Huge thank you to Eurodollar University members and subscribers. And until next time, take care.